So your profit is showing $5,000 and your cash is showing $400. And you're wondering why the discrepancy? Why is your profit different than the cash? Well, if you're asking yourself these questions, you're not alone. According to a small business cash flow research done by QuickBooks, approximately 61% of small business owners struggle with their cash flow. So what is the fix here? The fix is not necessarily looking at more spreadsheet, but it's looking at all three key financial reports together. First up, the profit and loss statement, which shows the profit or loss for the period, and it's answering the question, did I make more money than I spent? Second, balance sheet. The balance sheet shows what you own, what you owe, and how much the business is worth as of a certain date. And the last report is the cash flow report, which is showing the cash coming in and out of the business. So let's just take a look at an example. Maya's marketing agency. On September 5th, we can see that Maya invoiced one of her clients $8,000. Assuming no expenses, her profit went up by $8,000. By September 20th, on her balance sheet, she had approximately $5,000 in outstanding invoices from her client. And by September 30th, still looking at her financial, on the cash flow report, it's showing $0 collected from that invoice. So the profit isn't lying. Let's take a look at this a different way. On the profit and loss statement, you can see the $8,000 net profit. If that $8,000 is not taken out of the business, it will roll into the retained earning, which is in the equity section of the balance sheet. This is making the balance sheet stronger. You still have $5,000 in accounts receivable that is outstanding. So her client owes $5,000. Moving on to the cash flow statement, we can see how these two numbers are flowing up into the cash flow statement. It starts with the net income, which is $8,000, and the $5,000 outstanding accounts receivable is deducted from the income. Why? Because when your account receivable increases, it means you're not collecting cash. So that $5,000 is taken from the net income, because the whole purpose of the cash flow statement is to arrive at the net cash for that period. So cash flow from operating activities is $3,000. Then moving on to investing activities, we can see that Maya decided to buy $3,000 worth of gear. There was zero increase in cash. So what is the story here? Profit went up $8,000, but $5,000 of that is still unpaid because the account receivable grew. The cash did not change this month. So what is the key takeaway? Your profit does not turn into cash until it's collected. That is the main reason your profit is different than the cash. So this is very common in business models that are buy now, pay later, where you perform the service, but then you invoice later and the cash is collected at a later time. So in businesses where you collect instant cash, there is going to be a smaller time gap between when the purchase is made and when the cash is collected. Let's say you're a digital product seller. Your customer pays immediately. However, your card processor can withhold the cash for days. So it's still not immediately. However, there is a shorter waiting time for when you will receive the cash, as opposed to a business where it's buy now, pay later, where you have to invoice later and follow up. So here, the story loop, we're showing how the profit, equity, and cash is collected. So the profit rolls into the return earning in the equity section when it's retained in the business, and the profit does not turn into cash until it is collected. They're both important to the business. The profit is showing that your business model is profitable. However, you need the cash in order to pay your bill. So, in summary, your job is to keep earning, keep collecting, and protecting the cash. What is the biggest red flag? The biggest red flag is when you have a nice profit, however, your cash is consistently zero or it's negative. So, what it's saying is your business model is profitable, however, you are not collecting cash. And without cash, you are unable to pay your bills. And if it's something that continues, it will cause a lot of issues down the line. And that's typically the leading cause of small business failure in general. What is the strategy? So there are three questions you can ask yourself monthly when you're reviewing these three statements together. The first, when you look at the P&L, is, am I making money? Second, when you look at the balance sheet, am I building value? Right? Remember, the balance sheet shows the strength of the business. Your cash and your assets and your equity allows you to sustain hard time. If you have a cash reserve, for example, and you have a month where you're not making any sales, where your cash reserve is going to allow you to pay your bills. So don't skip on the balance sheet. It's a very important report. And number three, we have the cash flow report. That is asking the questions, can I pay my bills? So these are very important questions that you should ask yourself every month, right? As you're reviewing these three reports together. And after you do that, you take one action step. If you need to follow up on your unpaid invoices, if you realize that, hey, I have this tax payment coming up, I need to start setting money aside for my tax. That is a step that you can also take. So the goal is to get you into the habit of looking at your financials like a CEO and asking the right questions. The key takeaway here is one report only tells you part of the story. You should look at all three reports together in order to get a full picture, a complete picture of the health of your business. This was for educational purposes only. It's not personal advice or a guarantee. Talk to a qualified professional. And that's it for today's lesson. This was Vanessa, your CPA from Biz Money Insights and Strategies. Don't forget to comment, like, subscribe, and I'll see you in lesson 7. Take care.